Good morning, my dear students. Today we would like to discuss some points as continuation of last video, debt market. So today we would like to discuss types of debt instruments. We are already discussed what is meant by debt market and what is the difference between debt and bond. Now we would like to discuss what are the types of debt instruments. There are various types of debt instruments which are available, and let us discuss here debt instrument which is deal in Indian debt market. First one, government securities. What is meant by government securities? It is the Reserve Bank of India that issues government securities. It is also called G securities or GSEC on behalf of government. Reserve Bank of India issues government securities on behalf of the government is called government securities. These securities have a maturity period of 1 to 30 days. 30 years. Maturity period is having 1 to 30 years. It offers a fixed interest rate. Clear. The next one, that is corporate bonds. Corporate bonds are come from public sector units, and private corporations are offered for an extensive range of maturity period up to 15 years. As compared with these government securities, corporate bonds carry higher risk, which depends upon the corporations or industry or company where the corporation is currently operating, and the rating of the corporation. However, even though these bonds are also give higher return than these government securities, it is highly risky and it offer high return also. Clear. The next important instrument deals in debt market, that is certificate of deposit. Commonly it is known as CDs. This is a negotiable money market instruments. CDs are a negotiable money market instrument, which is usually offer higher return than bank term deposit. Term deposit means fixed deposit, which are issued in demat form and also as use and promissory notes. Bank can offer CDs which have a maturity period between 7 days and 1 year. Many financial institutions have vary this maturity period in between 1 to 30 years. There are some agencies like ICRA, Fitch, K or CRISIL, etc. that offer rating of CDs. Okay. The next one, that is CPs or commercial paper. Commonly we known as CPs, commercial paper. There are short-term securities with maturity period of 7 to 1 year, 7 days to 1 year. That means 7 to 365 days. It is issued by corporate entity at a discount to face value. A commercial paper is in India is a monetary instrument issued in the form of promissory notes, as in the case of CDs. It acts as a debt instrument to be used by large corporate companies for borrowing short-term monetary funds in the money market. With the introduction of this CPs in Indian money market is an innovation in the financial system of India. Clear. This commercial paper has become effective instrument for corporate companies to avail the short-term finance or short-term funds from the money market within the shortest span of time. Clear. The next one, important one, that is treasury bill, TBs. Commonly it is known as TBs, treasury bills, which is also a short-term securities issued by the RBI, that is meant to fund temporary requirements to the government. The maturity period on treasury bills ranges from 91 days to 1 year. It have a face value of rupees 100, but do not have any interest payment. Clear. This is a very important feature of this treasury bill. The next one, that is zero coupon bonds. Zero coupon bond. ZCBs. Commonly we can say that ZCBs. ZCBs are available at a discount to their face value. There is no interest paid on this instrument only because of it is issued at a discount rate. But on maturity, the face value is redeemed from the RBI. The bond of face value is 100 will be available at a discount, for example, rupees 80. and the date of maturity it is after 2 years or something like that. It is implying an interest rate on the investment when the bonds are redeemed rupees 100 will be paid. That is the difference. That is the margin. That is an interest. That is considered as an interest. The difference between the issue price and the face value is the return. Clear? There is no interest. The next one, that is deep discount bonds. DDBs. Typically, these DDBs will have a market price of 20% or more below its face value. These bonds are perceived to be riskier than similar bonds and are thus priced accordingly. It is perceived to be a riskier instrument. These long coupon bonds are typically long term and issued with call provisions. Investors are attracted to these discount bonds because of their high return or minimal chance of being called for a maturity before the maturity. Clear? The next important one, that is public sector units tax-free taxable bonds. These are tax-free taxable bonds. Tax-free bonds or debt instrument that pay fixed coupons either semi-annually or annually till maturity. An investor gets principal and last coupon. The amount invested in tax-free bonds as well as the interest earned on the investment is exempt from the income tax. That is why it is called as a tax-free investment. The amount invested in tax-free bonds as well as the interest earned on the investment is fully exempted from Income Tax Act under the Income Tax Act 1961. Even though these bonds do not offer any additional taxation benefit under Section 80 CCF of the Income Tax Act. Clear? Then the next important instrument, that is debenture. It's a very well-known instrument as far as it is concerned. Debentures means a company may raise long-term finance through public borrowings. These loans raised by these by these companies commonly call it as debentures. It is an acknowledgement of a debt. Debenture is a type of debt instrument that is not secured by the physical assets or collateral security. It is backed only by the general creditworthiness and reputation of the company or the issuer. Clear? It carries a fixed rate of interest. Then the last important instrument, that is government guarantee bonds. GGBs. Government guarantee bonds have an inherent risk of the default. That could mean a bondholder never gets the principal back upon maturity and loses out on periodic interest payments. Simply we can say that this guarantee bond removes this risk by creating a backup payer in the event that the issuer is unable to fulfill its obligation. Only because of this lowered risk, guaranteed bonds generally have a lower interest rate than non-guaranteed bonds. A guaranteed bond can be municipal or a corporate, backed by the bond issuer or a government authority. Clear? It is guaranteed by the government. So these are all the important instruments which are deals in bond market, particularly in Indian bond market. Okay. Now we move to a simple area, that is redemption option or provision on debt instruments. So what are the methods? There are 4 methods. First one, call provision. Next one, put provision. Next one, conversion. And the last one, principal payment and average life. First one, call provision. Call provision means some bonds are issued with a provision, that is which the investor can redeem the bonds at a specified date and a price before its maturity. That is called provision. Such a provision is meant to safeguard the issuer. Callable bonds have a higher interest rate as compared to non-callable bonds. So what is the logic behind these bonds? Bonds are issued with a provision which an investor can redeem these bonds at a specified date and price before its maturity. Clear? Then next, put provision. Put provision means that give an investor the option to sell, that is put option, we have discussed it, put, to sell the bond to the issuer prior to the maturity at a specific date and time. Since what is mean? This is meant to protect the investor. The interest rate on such bond is comparatively lower. There is a provision to put, to sell. Clear? The next, conversion. It can be converted. Some corporate bond allow investor convert this bond in common stock. That is, common stock means equity shares. instead of redeeming bond for a cash payment. That is called a convertible bond or conversion bond. These bonds are also known as convertible bonds. Then the last one, that is principal payment and average life. Some bonds are linked to the average life of the instrument. These instruments are traded and priced as per their average life rather than the maturity date. These are all the important redemption provision or provision on debt instrument. Okay. By these words, let us conclude today's class. Thank you to all.